Hello and welcome to 8 Minutes. www.8minutes.in is where you can contact us. Today we are going to discuss about angel investing versus venture capital. Both angel investing and VC funding are critical, as you know, to high growth startups funding strategy. There are some similarities and some overlap between the two actually. So we'll be discussing angels and VCs based on first is their investment goals. What are the investment goals of angels and VCs? What are the stage of companies they invest in and the volume of capital, that how much capital they invest. Generally angels investments goals and stage of companies are initial pre-seed companies, as you can guess, and the volume of capital is not as large as VCs, but it again depends on deal to deal. Angels are accredited investors. They are registered investors, wealthy people, HNIs you can say, who invest their own money in the entrepreneurial companies, that is startups. So angels invest their own money. VCs generally don't do such things. They represent venture capital funds of investment dollars from sources that include high net worth individuals, corporations, pension funds, or public entities. So, unlike angels, VCs, venture capital firms invest others' money into the startups. They spend 80 or 70 to 80% of the time in the post seed deals. That is the seed stage funding is there. So there is also a post seed, that is series A, series B, series C, or IPO, pre-IPO stages. So most of the time spent or invested by VCs is into the post seed deals or even the seed deals in certain cases. As startups grow, angel participation in the later stages deals declines somewhat, while VC's participation increases significantly, because there's a direct correlation between VCs and the stages, because the more the amount required in the latter stage, the more participation from the VCs. The less amount would be required in earlier stages, so startups would approach generally angel investors. Angels, as I said, are often the first equity investor in a company. Yes, generally they are individuals, they are wealthy individuals, so they are the first investors in a company. A startup would rather approach an angel investor initially than approaching a venture capital fund. When a VC, that is a venture capital fund, invests in seed stage companies, those rounds, that is the first round of funding, the later second round of funding, are typically larger than the angels only round. So maybe an angel has invested $1 million or $2 million in the first round or even the second round, but VCs would invest $100 million in the first round itself. This, for example, it is not unusual to see venture capitalists and angel investors syndicate on a larger seed round deals. So it is common to see that sometimes you see angel investors and VCs collab together on a larger seed round or on a follow-on investment round, particularly in regions of country where VC capital is less plentiful. So if you have less VC firms in certain countries and you have more number of angel investors, so it is a geographical factor maybe, where you can see angels and VCs working in hand to hand. Angels take a hand-on approach to de-risking the company. What this means is they personally see the due diligence part, they personally see the board participation, and angels get involved in every single thing till closing the deal. Around 60% of angels with an entrepreneurial background accept an advisory role, and more than half take a board seat. So an angel investor can end up taking an advisor or a mentor's role, and this is the amount is 60% nearly, and more than half, that is more than 50%, may even take a board seat in your startup. Founding teams benefit from angels operations and functional expertise because they themselves might be entrepreneurs extensive industry connections. Angels also help startup reach potential business partners, potential customers, technical resources, and more. So it is not the question only of funding. They also help the startups in operational issues, functional issues, and developing and networking and communicating with the business partners or even the customers or technical resources and certain other things. So angels are not only present for funding only. But this doesn't mean that VCs don't share their expertise. They also share their expertise. Their advice, in fact, and contacts are invaluable, and in fact, more valuable than the angels, I would say, in certain cases. However, the involvement of VC is not direct, as in case of angels. It may be through teams. They may be to certain teams might be allocated to certain startups. So it is more structured and conducted through board of director activities. So they more or less they follow a legal structure and they are conducted. The involvement is conducted through a board of director activities. Angels tend to invest close to home and are more diverse. So angels would prefer, since they are individuals, they would prefer their startups to be in front of them. By front of them, I mean that they would be close to their home, close to the area of operation. And most typically, angels invest in regions where they live in or the industries which they are aware of, they are knowledgeable of. Angel investors pursue deal flow while angel groups, there are certain angel groups, you can say, individual angels, friends, associates, and from direct engagement with entrepreneurs. So how they find certain startups? It may be a recommendation from an angel group. It may be a group where startups come to pitch to angels. It might be an individual angel, the peer angel, or friends. Some friends may have suggested the startups, or associates. They might be an associates of a professional body, or a direct engagement with entrepreneurs also in certain cases. It is important to determine which angel and which angel groups are viable option and which VCs are right VCs, if any, to work with based on the startup stage of growth. So this is important from a startup's point of view. We had discussed in the earlier sessions that the research has to be made of the potential investors. So this is what it is talking about. It is important to determine which angel and which angel groups are viable options, and which VCs, if startups are going for venture capital firms, then which VCs are the right VCs. Early stage companies should consider angels for funding. If the amount of funding or the ask is very nominal, maybe $1 million or something like that, as well any VCs specifically focused on early stage opportunities. There might be certain VCs also which are focused on early stage opportunities. So early stage startup should contact these guys, and a later stage startup would typically rarely rely less on angels as a funding options, seeking out instead VCs who are primarily work with later stage or break even or revenue generating companies. So if your startup is a later stage companies, we would advise you not to go to angel investors for pitching your startup. Instead, go for VC firms who can have a greater exposure and a larger amount of ask can be pitched to them. If your startup is a later stage, it has a break even and a good revenue. Many angels invest in pre-revenue also. There are certain companies which are pre-revenue. There are certain startups. It might be a concept stage startup or you can say an idea stage startup. So angels would invest in such startups. Most VCs will not. So VCs would not invest mostly in pre-revenue. They need funds as a return of investment. They will invest funds only if there is a good ROI, unless their focus is on early stage companies. So there might be a rare scenario where a VC would invest in a pre-revenue company. Entrepreneurs need to prepare a capital plan that matches with the source of investment with miles to be funded. What it means is you should have a cap table. Since both angels and VCs tend to invest close to home, start local and then branch out regionally. So, as we discussed, both VCs and angels actually invest in a predefined geographical location, maybe a close to home or a close to office. So, startups should initially start a local hunt for VCs and angels, and then regionally they can branch out as they go in a later stage. With extensive industry connections, angels also help startup reach potential business partners, potential customers, and technical resources and more. This is what we have discussed earlier. Thank you for watching and listening to this video. You can follow us on 8 minutes, that is www.8minutes.in. Please subscribe to my channel Nischalati. Thank you and have a nice day.